Every single day since February 28th, the American economy has been losing $500 million it will never get back. Not per week, not per month, per day. And that number is not slowing down. It is accelerating. The Strait of Hormuz, a narrow stretch of water barely 21 miles wide, carries 1/5 of all the crude oil and liquefied natural gas that moves across this planet. It has never, not once in modern history, been completely shut down. It is shut down right now. Brent crude crossed $110 a barrel on Friday. 3 weeks ago, it was sitting at $70. That is a 50% move in less than a month. The kind of move that rearranges economies. The kind of move that changes what ordinary people can afford. But here is what nobody is telling you clearly enough: the price at the pump. The number that is making people grimace every time they pull into a gas station. That is not the crisis. That is just the opening act. There are 4 more waves of economic pressure building behind it, each one larger than the last, each one on a different timeline, and most people will not see any of them coming until the damage is already done. What I want to walk you through today is not just what is happening, it is why your own mind is working against you right now, and what that blind spot is going to cost you if you do not override it. Wave 1. The number on the SIG, the national average for a gallon of regular gasoline, has moved from just under $3 to $3.70. In California, drivers are now staring at numbers above $5.30. Diesel, the fuel that moves every refrigerated truck, every cargo shipment, every pallet of goods you buy, has surged 36% to nearly $5.10 a gallon. The average American household spends roughly $2,500 a year on fuel, about $50 a week. So when that weekly bill climbs by $10 or $15, your brain does something specific with that information. It files it under annoying but manageable, and then it moves on. And the reason it is wrong reveals something important about the way human beings process financial danger. Psychologists have documented a pattern called mental accounting. We do not think about our money as one pool. We unconsciously divide it into invisible buckets: gas, groceries, entertainment, savings. When one bucket suddenly overflows, we do not calmly rebalance. The gym membership disappears, the restaurant visits stop, the vacation gets canceled. The investment contribution you told yourself you would increase this year quietly stays exactly where it is. When fuel costs spike, the first casualties are always experiences. Not because experiences got more expensive, because your survival instinct reclassified them as luxuries the moment a mandatory expense jumped. And that instinct is about to get a lot louder. Because gas is not the crisis. Gas is just wave 1. The architecture of the shock. Nobody is framing this correctly yet. What is happening right now is not one price spike. It is a rolling sequence of economic shocks arriving on different timelines, each one compounding the damage left by the previous one. By the time most people recognize the full picture, 4 of the 5 waves will have already landed. Wave 1, fuel, you already know. It showed up within days of the strikes. Wave 2 is landing right now, and most people are just beginning to feel it at the checkout line. Wave 3 will not arrive for months, but it is already mathematically locked in. Wave 4 will hit anyone who has a flight booked this summer. Wave 5 is the one almost nobody has connected yet. And it may be the most consequential of all. Let me take you through each one. Wave 2, what you eat. Diesel does not just power passenger vehicles. It powers the refrigerated trucks that carry produce, meat, and dairy from farms and distribution centers to your grocery store. These are the items that cannot sit in a warehouse waiting for conditions to stabilize. They move, or they spoil. A 36% diesel spike means the cost of moving perishable food just went vertical overnight. Supply chain researchers have been clear about this. Grocery stores are the first place consumers will feel price pressure beyond gas stations. And the less shelf-stable the item, the more exposed it is to what is happening right now. Here is the complicating factor. Retailers do not raise prices instantly. They absorb cost increases for a while, cushioning the shock to protect customer loyalty. But those retailers have already spent the past year absorbing tariff-related cost increases. There is almost no margin left to cushion a second hit. When that cushion runs out, and it will, the sticker price catches up fast, and it catches up all at once, rather than gradually, which makes it feel sudden and disorienting, even though it was entirely predictable from the moment diesel prices moved. Wave 3, the invisible fuse. This is the wave that should concern you most, because it operates on a delay that makes it almost invisible until the damage is irreversible. Fossil fuels account for up to 80% of fertilizer production costs. The countries most directly disrupted by this conflict, Iran, Qatar, Saudi Arabia, Bahrain, the United Arab Emirates, are among the world's largest fertilizer producers, and 1/3 of the global fertilizer supply passes through the Strait of Hormuz, the same waterway that is currently closed. So the food you eat in September and October is getting more expensive right now. Farmers are paying elevated input costs this month for crops that will not reach your table for another 6 months. By the time that price increase shows up in your grocery bill, most people will have completely forgotten that the seeds of it were planted in March. This is how economic shocks do their most lasting damage. Not through the visible spikes those people see and prepare for, through the delayed waves that arrive long after attention has moved elsewhere. Wave 4, your summer plans. Jet fuel has surged approximately 85% since the conflict began. Airlines from Qantas to Scandinavian Airlines to India's major carriers have already announced fare increases. Unlike gasoline, which fluctuates daily and can drop as quickly as it rises, airlines bake fuel costs into their pricing models months in advance. Those higher fares do not reverse quickly, even if oil prices fall tomorrow. If you have a summer trip planned, reprice your tickets today. The number you see now is likely lower than the number you will see in 6 weeks. Wave 5. The rate trap. This is the one almost nobody is connected to the conflict yet. At the start of this year, the Federal Reserve was widely expected to begin cutting interest rates. Lower rates would have meant cheaper mortgages, cheaper car loans, cheaper credit card debt. That expectation is now effectively dead. Some economists project the first rate cut will not arrive until the third quarter at the earliest. If inflation accelerates beyond current projections, rates could move in the opposite direction entirely. If you were planning to buy a home, refinance, or make any major finance purchase this year, the math just changed underneath you, without anyone sending you a memo. And it is not just individual households. When millions of people simultaneously delay cars, homes, and major renovations because they have lost confidence in what they can afford tomorrow, that collective pause has a name in economics. It is called a demand freeze, and demand freezes have a way of dragging entire economies down with them. The gap between what you see and what is coming. Let me ask you something. When you first heard that oil prices spiked because of the Iran conflict, how many of those 5 downstream effects did your mind immediately connect? 1? Maybe 2? You are completely normal, and that normality is exactly the problem. There is a well-documented phenomenon in behavioral psychology called anchoring bias. When you encounter a complex, multi-layered problem, your mind does not process every layer simultaneously. It grabs the most visible data point and uses that single number as a stand-in for the entire situation. Right now, for most Americans, that anchor is the price at the gas station sign. $3.70, $4.20, $5.30. Whatever it reads in your neighborhood, that number has become the mental proxy for the entire economic impact of this conflict. And because gas prices feel survivable, annoying but survivable, your internal threat assessment quietly files the whole crisis under temporary inconvenience. Meanwhile, one leading economist estimated that the fuel spike alone could push monthly inflation to 1% in March, the highest single-month increase in 4 years. Annual inflation approaching 3%. And that calculation does not yet account for groceries, fertilizer, airfare, or the compounding effects moving through every supply chain that touches something you buy. The International Energy Agency has described the current disruption as the greatest global energy security challenge in modern history. not a moderate disruption, the greatest in history. And the anchoring bias is comparing the number at the pump to last month and quietly whispering, "We'll manage." This is exactly what happened in 22 Tau. After Russia invaded Ukraine, gas spiked. People grumbled and adjusted. Then the shock bled invisibly into groceries, rent, services, and everything else. Inflation hit 9%. By the time most households grasped the full scope, a year's worth of purchasing power had already evaporated. You are not irrational for missing this pattern. You are running the same cognitive software as everyone around you. Recognizing that software is the first step toward overriding it, your investments and the fear response. Now let us talk about what is actually keeping people up at night. The S&P 500 has dropped nearly 7% from its January peak. The Dow posted 4 consecutive losing weeks, its longest losing streak in 3 years. The Nasdaq briefly dipped into correction territory, falling close to 10% from its high. The Russell 2000, which tracks smaller companies more sensitive to borrowing costs, crossed the official correction threshold last Friday. Gold, which most people assumed would function as a safe harbor, spiked above $5,400 per ounce and then crashed more than 10% in a single week, its worst performance since 1983. Wall Street's fear gauge, the VIX, surged from the mid-teens to nearly 32. When you absorb all of that simultaneously, something specific happens in your nervous system. The threat detection circuitry in your brain starts producing a single overwhelming signal. Sell. Get out. Protect what is left. This is loss aversion, one of the most heavily documented patterns in behavioral finance. Research from Princeton established that the psychological pain of losing money is roughly twice as intense as the pleasure of gaining the same amount. A $5,000 portfolio loss does not feel like a $5,000 emergency, not because you are bad at math, because your nervous system evolved in an environment where losses of sufficient magnitude could be fatal. That wiring has not updated for retirement accounts. But here is what the actual data shows about acting on that impulse during geopolitical crises. An analysis spanning 20 major military interventions since World War II found that the S&P 500 fell an average of 6% during the conflict and then recovered fully. A separate study covering 40 geopolitical events across 85 years found the average first-month loss was less than 1%, followed by a 3.4% gain over the following 6 months. The pattern is remarkably consistent. The people who sold in panic locked in their losses and missed the recovery. The people who held through the turbulence captured it. After the market crashed in March 2020, it recovered to its prior level in 57 days. Many of the investors who fled at the bottom never re-entered. They waited for certainty that never arrived while the recovery happened without them. And this is where the cruelty of the math becomes precise. The market's best days and worst days cluster together on the calendar. Miss just 10 of the best trading days over a 20-year period, and your returns get cut roughly in half. Miss 20, and you barely keep pace with inflation. You cannot capture the upside if you were not there for the downside. Behavioral economists call this the behavior gap. The difference between what markets actually return and what the average investor earns. That gap exists almost entirely because people buy when they feel optimistic and sell when they feel afraid. The exact sequence that destroys long-term returns. Not because investors lack intelligence, because they are running ancient software in a modern financial system. The scenario that keeps serious economists worried. I am not going to soften this, because there is a scenario that deserves your full attention. Stagflation. Rising inflation and slowing economic growth occurring simultaneously. It is the worst-case configuration for household finances because the tools that address inflation, raising interest rates, actively suppress growth. And the tools that stimulate growth, lowering rates, pour fuel on inflation. There is no clean exit from the combination. The Federal Reserve is already caught in this bind. They left rates unchanged at their most recent meeting because the conflict has made every direction dangerous. Cut rates, and you accelerate already rising inflation. Raise them, and you risk tipping an economy already strained by energy costs into contraction. If the strait remains disrupted, and oil production across Kuwait, Iraq, Saudi Arabia, and the UAE continues at reduced levels, currently running at least 10 million barrels per day below normal. Some analysts project Brent crude approaching $130 a barrel. At that level, we move from inconvenience into structural damage to household budgets, consumer spending, and corporate earnings across nearly every sector. The historical precedent is sobering. The 1973 OPEC embargo led to a 2-year economic contraction. The 1979 Iranian Revolution doubled oil prices and triggered another recession. The 2008 oil spike preceded the financial crisis. The pattern is reliable enough that economists treat major oil disruptions as one of the few dependable triggers for stagflationary conditions. The current disruption is being described as the largest supply shock in the history of the global oil market. That is not a sentence that circulates casually in economic analysis. It should change the seriousness with which you are approaching the next several months. And even in the best case, even if the strait reopens tomorrow and production resumes, relief will not be immediate. There is a well-documented pattern economists call the rockets and feathers effect. Prices rise like a rocket when costs increase. They drift back down like a feather when they fall. After Russia invaded Ukraine, gas prices moved within days. They took months to retreat after Gulf Coast refining was disrupted in 2005. The Strategic Petroleum Reserve Release, the largest in International Energy Agency history, buys time. It does not repair the underlying rupture, what you can actually control. Here is the part that matters most, because the difference between people who come through economic shocks financially intact and people who come out damaged has almost nothing to do with what happened to them. It has almost everything to do with what they did while it was happening. The single most expensive mistake investors make during geopolitical crises is moving to cash. Every instinct may be pointing in that direction right now. But the research across multiple institutions and multiple historical crises says the same thing. Abandoning your position does not eliminate risk. It trades market risk for inflation risk and opportunity cost. And inflation risk in a period like this, one is not a minor concern. There is no risk-free option. Being too conservative is a form of risk, because money sitting in cash during an inflationary period loses purchasing power quietly and continuously, without the dramatic notification that a portfolio drawdown provides. Pressure test your emergency fund. The standard guidance is 6 to 12 months of expenses in a liquid accessible account. The top high-yield savings accounts are currently paying above 4% annually. If your cushion is thin, this is the moment to strengthen it. Not because the worst case is certain, but because the psychological security of knowing you can absorb a shock fundamentally changes the quality of the decisions you make under pressure. When you have runway, you do not panic. That calm is worth more than the interest rate differential between whatever you currently earn and what a high-yield account offers. Think of your emergency fund less as a savings vehicle and more as insurance against your own fear response. Its value is not primarily financial. Its value is that it keeps you rational when markets are not. Audit your discretionary spending before the later waves arrive. Gas is already here. Groceries are coming. Airfare is coming. The interest rate repricing is coming. If you wait until all 5 waves have landed before adjusting your budget, you will be reacting under pressure instead of moving proactively while you still have options. If you invest on a regular schedule, keep going. I understand that this is counterintuitive. Every instinct says, stop adding money to something that is falling. But decades of evidence says the opposite. When you invest a fixed amount on a consistent schedule, you automatically purchase more shares when prices are depressed and fewer when prices are elevated. The volatility that feels threatening right now is quietly lowering your average cost per share. This is dollar cost averaging, and it works specifically because of the chaos, not despite it. The shares purchased during this period will, in all probability, represent some of the strongest investments made in this decade. The investors who paused their contributions during past crises missed the discount and bought back in at higher prices. The investors who continued bought at the bottom without even trying to time it. Finally, map your specific exposure to energy costs. This is personal and looks different for everyone. Long commute in a fuel-inefficient vehicle? The math on a change just shifted significantly. Carrying high-interest revolving credit card debt? Attack it now, while you still can. The Fed is not cutting rates on any near-term timeline, which means your borrowing costs remain elevated longer than most people anticipated 6 months ago. Small business owner moving physical goods? Your shipping costs just increased materially. This is the moment to renegotiate supply contracts, consolidate shipments, or identify closer sourcing before the diesel surcharge erodes your margins further. The difference between people who get through this and people who don't. Research on past economic shocks, 1973, 2008, 2020, 2022, reveals a pattern that defies most people's intuitions about what separates the households that emerge intact from those that emerge damaged. It is not income level, it is response time. The households that fared best were not the wealthiest ones. They were the ones who adjusted earliest, who recognized the signals before the full pressure arrived and made small, unglamorous moves, trimming discretionary spending, fortifying their emergency savings, maintaining investment contributions, reducing high-interest debt. None of those moves are dramatic. None of them generate interesting stories. Nobody posts about the month they redirected $200 from dining out into a high-yield savings account. But compounded across the 6 to 12 months that an economic disruption typically takes to fully cycle through the system, those early adjustments create an enormous gap between the people who made them and the people who waited. Not because the individual moves are large, because they started before the pressure arrived. You are thinking about your money right now. Most people will not think about any of this until the 4th or 5th wave has already hit their bank account. By then, the window for proactive adjustment is closed. Your window is open right now. The anxiety you may be feeling is not irrational. It is appropriate signal. It means you are paying attention to something real. The mistake is not feeling it. The mistake is letting it choose for you. Panic selling, freezing, telling yourself it will blow over. Those are the responses your nervous system was built for. They are precisely wrong for this moment. The right response is quieter. Review your budget. Verify your emergency fund. Map your energy exposure. And once you have taken those steps, stop consuming financial news designed to amplify fear rather than inform action. You have already done the work. You do not need the fear anymore. The disruption does not have to make your decisions. You can make them yourself.